Welcome to Shooting It Straight with Stan. I'm your host, Stan, the annuity man, America's annuity agent, licensed in all 50 states with an itch in my nose. Sorry about that. Was gross. What are you doing, Stan? Picking your nose like that? That's gross. I understand, but you get older and just everything falls apart. Nose, eyes, everything. Everything. Hey, today's topic is a good one. And Chester the Grinch is back there with his Wild Wild West cowboy hat on. Why? Because it's been the Wild Wild West here with banks a little bit. Nod your head. And today's topic is annuity companies aren't smarter than banks. They're not. They're just more regulated. Let me tell you a little story. Long time ago, a few years ago, there was this pandemic. Some say it came from a wet market where like turtles were making out with bats who were loving on ducks, who were then kissing the snakes. I don't know what was going on. And then some say it went from a lab in China over here. Regardless, it was a mess. Can we say, it was a mess? It was a mess for the world. It's a mess for this country. Our politicians, both sides, decided to print money to keep people home, to keep the grease on the skids, as they say, going. And that caused inflation. So inflation taking off, and our Fed, Chairman Powell and his friends at the big marble table where they have both donuts and bagels that we pay for. So if you want the bagels and the donuts, you can get that. So they raised interest rates drastically. So what happened with that? Well, as you know, or if you don't, I'm getting ready to tell you, bond prices are like seesaws. Interest rates go up, bond prices go down, and vice versa. Okay? So interest rates went up, bond prices went down, and some of those banks had to fire sale the bonds, which leaked out to the internet. We're in a global 24/7 nature right here with the social media. And there was a panic, and all hell broke loose. Hell broke loose, braked. I don't think so. You know what I'm saying, though. It got ugly, and it got scary. And there was a run on the banks. Now, of course, the banks in question, I don't know enough about the details, but what I've read from people that I actually trust in the news, it was not managed as well as it should have been. Hindsight 2020, like back-tested returns, right? Don't buy back-tested return numbers. But the bottom line is there was a run, and there's issues. There's still issues. One of my former employers, UBS, bought Credit Suisse. No, they didn't. It was a shotgun wedding. They were forced to buy Credit Suisse. Oh, I think it's the Grinch, man. He's making my nose itch. They were forced to buy. I mean, there's all kinds of things that are happening right now that, when the government comes out and says, all is well, all is well, all is well. When I hear that, I envision Animal House movie where the guy's at the parade and he's saying all is well and people are just trampling him. When the government says all is well, I'm like, really? I just kind of look straight at them. So it gets to the topic of annuities aren't smarter than banks. They're just more regulated. You say, wait a minute, explain. I'm going to do it in English. Now, the good news is I did it at a very high level with my podcast, Fun with Annuities. If you go to that, you can pull it on all major podcast platforms, or you can watch the video of the Fun with Annuities YouTube channel. And I had John Lenz on. I call him the annuity architect, but it's 40 years of absolute smartness in the annuity industry. We broke it down, banks versus annuity companies. I'm not saying one's better than the other. I'm just saying that annuity companies are more regulated. Also, they put in place things so that there really can't be a run on the annuity company. Let's take MYGAs or indexed annuities or variable annuities or deferred annuities as an example. You hold them for a term, so there's a surrender charge. So if there's a run on them, then you're going to have to pay the surrender charge to get out of it. A lot of these multi-year guarantee annuities also have what's called market value adjustments, meaning that if you buy a MYGA and interest rates go up after you buy it, then the sales charges are going to go up if you try to liquidate it. The bottom line is the annuity industry has put in place features to not only protect you, the consumer, which is their ultimate goal, period, but to protect the industry as well. See, with banks, as you know, there's a window, and you'd say, I want my money. I want my money. I want my money. I can just hear my mom. I want my money. I want my money right now. With annuity companies, life insurance companies issue annuities, there's no window. And let's get back to the bonds. Remember, I talked about the banks having to sell the bonds in some cases for whatever those ratios are with banks that they have to hit from a solvency issue, etc. Annuity companies are buying the same investment grade bonds. They just don't have to sell them. They're going to hold them to term. They're going to hold the coupon. Okay. It's really that simple. The other thing too is with lifetime income products. Let's go over those real quick. Single premium immediate annuities, SPIAs, deferred income annuities, DIAs, which is the same thing as a SPIA, you just defer it. Qualified longevity annuity contracts, QLACs, which is a DIA that you can use in an IRA, and then income riders attached to an index annuity, variable annuity, etc. Those are the 4 ways to get lifetime income contractually. Let's talk about SPIAs, DIAs, and QLACs for a second. Those are irrevocable. When you buy them, you're ripping the knob off a water faucet. In this case, it's an income faucet. Income's going to flow. We can structure it however you want to structure it. There's 40 different ways at least, but most people structure it so you get a lifetime income as long as you are breathing. And when you die, 100% of any unused money goes to the beneficiaries because the income stream amount is a combination of return of principal plus interest. But there's no run on that. There's no run on lifetime income. In other words, I want my lifetime income back. I want my immediate annuity money back. Nah, back. Same thing with DIAs. Back. Same thing with QLACs. Back. So the annuity industry, from a product design standpoint and what they offer from a limited product standpoint, it prevents runs, people panicking and running and getting their money out. It prevents that. Doesn't make them smarter than banks. It just is what it is. They're also not making car loans and all that stuff. They're not doing any of that. There's stringent rules for annuity companies to put 100% or more of your money in investment grade bonds day one when you buy a fixed annuity. We can go down the rabbit hole. Well, Stan, investment grade bonds are really run by China and their brothers in Russia and also UFOs. We could do that all day long if you want to, but those are the rules. Investment grade bonds. Someone asked me the other day, well, what happens, Stan the annuity man, if these AA plus carriers, these AAA carriers go out of business? I'll tell you what happens. Me and you are in the grocery store fighting for bread, and I'm going to win because I'm going to kick you in the knee first and then punch you in the throat and then take you, nicely, of course, not really hurt you, and then take the bread from you. In other words, there's no power. It's anarchy. So don't even go down the rabbit hole, period. I'll let you split it up under the state guarantee fund rules if you want to and wear belt and suspenders like my Uncle Chester does at the family reunion. You know what I'm talking about over there. I mean, he's seen it. You can wear the belts and suspenders if you want to. Here's the other thing, too, about banks and annuity companies. Annuity companies and their actuaries, they're always running stress tests and what-if scenarios and worst-case scenarios and all this stuff all the time. They're not waiting for things to happen for them to do that. Now, the bank situation that just happened, did that send the actuarial analytical group at life insurance companies into a tizzy? Yeah, they all ran out of the closet and went, and then they ran back in and did their mathematical calculations. I love those guys. I mean, they took math classes they took math classes like if I would have walked in the first day in college and just seen like the first, syllabus or whatever, I'd have been, okay, it's time for me to leave now. Come on, Chester, bring your cowboy hat. We're going out of here. Okay, we're going to go take basket weaving. But seriously, annuity companies, once again, they're showing the consumers that you might hate all annuities like the guy on TV said. You're an idiot if you do, because you already own one. It's called Social Security. You might just, all annuities are expensive. That's dumb too. You might want to stop talking because you're making a fool out of yourself. But what the annuity companies are showing right here, the rules that are in place are strong. And the National Association of Insurance Commissioners, NAIC, each state has a commissioner that oversees annuities, fixed annuities, etc. Those cats and catettes are doing a great job because their job is to protect the consumer. Their job is to make sure that these carriers that they are approving for their state, in their state, to sell product to their residents are solvent, are following the rules, etc. What happens if somebody doesn't follow the rules and lies on the financial paperwork? They will absorb them. That's what the state guarantee fund is all about. Or a company, a larger company will come in and buy that smaller company. And so the confidence, the golden goose of confidence is in place. So banks are not smarter than annuity companies. Annuity companies are just handcuffed not to do stupid things, because if they were given the reins to do stupid things, they would do stupid things. They just don't. And that's a good thing. And I applaud the National Association of Insurance Commissioners, who are probably wincing at this, like, oh, Stan, oh, he gave us a compliment. Oh, we didn't need that. They're doing a good job. They're doing a good job overseeing and making sure. And I'm going to tell you this right. I'm going to tell you this right now. This banking thing that just happened is gold for the annuity industry, not from the standpoint of money flowing in, but what it's going to do is ramp up the NAIC to oversee more stringently and to make sure that the carriers are just, everything's in order. Not that it wasn't before, but I'm telling you, whatever fine-tooth comb they had, they got a bigger comb. And that's a good thing, because there's 11,000 baby boomers hitting age 65 every single day looking for guarantees, looking for the promise and the guarantee contractually that they're going to get income for life, or they're going to get the principal protected. That's a good thing. So I love this country. I might sing, but I'm going to tell you something. I love this country. I'm going to tell you why. Because situations like this that are happening with the banking industry make us stronger. We don't just sit back and go, man, that stunk. That hurt. That's going to leave a mark. You know, it's like Chris Farley in the movie when he got hit by the 2x4. He goes, it doesn't hurt here or here. It hurts right here. The scars from something like this will help the consumer. The scars from lessons learned will make us better. It always does. That's why we are who we are. The United States of America. And I am proud to be America's annuity agent. My name is Stan the Annuity Man. See you next time.